Hello, everyone. Welcome to Office Hours for TradersPost on September 13th, 2024. The kids are back at school. We can spend more time focusing on what really matters, making money. And we're so happy to have everyone here today. I'm the moderator here, Tom Hartman. I'll be the host. I was just watching the All In podcast. I'm thinking moderator. That's what's in my head.
Yeah, I was like, are we debating today? John and I are going head to head.
And we're here with, as always, with Mike Christensen, CSO, and CEO John Wage, who, I mean, we have so many questions this week. It feels like a lot has gone on over the last 7 days. So we'll hit you up. We're going to be, as we did last week, we're going to be doing Office Hours, which is our sort of market watch show at 4 o'clock. But before we do, let's start with the questions that you have submitted to us over the last week about using TradersPost. First off, I would just love to say just a little shout out to your boy Tom Hartman over here with Sessions Alerts, which is the indicator that we just put out on our blog at traderspost.io/blog, where it allows for you to set an alert to send at a specific. Essentially, it's aiming to be able to send an alert to close your positions before the session ends. But the reason I'm giving myself a pat on the back is that someone did message into support to say. To tell support, to tell Cam, to tell me that I'm a genius. So that's written. He's a genius. Using lower time frame candles that way, that's so much more accurate and effective than other methods. I agree. I did not send that in. It's not a bot. It's not AI. It's take that to the bank.
I wish you would have let me present this, Tom, because like you had to do an attaboy for yourself, but we're all very proud of you here, and I should have just presented it, and then you could have done the humble thing, and done a little more humble bragging. But you're like, yeah, props to you. No, seriously, props to Tom. You write some of the best Pine script out there. That particular script is obviously very useful to traders so that they can kind of close out positions before the end of the session. And the session candles concept was great. I'm glad we've incorporated that.
I'm the youngest of 13 brothers and sisters, and so there is no kudos coming my way unless I give it. That's my.
You had to dance. You had to dance for some food, didn't you?
That's exactly right. All right, so I want to. I was going to save this for after all the questions, but I think I'll do this at the beginning. And this is really be for John. We got like a bunch of feature requests, and I love to have that as like a segment for Office Hours, where we just go get your opinion, your flash in the pan opinion on the features that some of these people ask. The one that comes on the heels of something that we talked about last week, which is about queuing orders, having orders in a queue. Someone is bringing up a slight modification to that, which is about queued orders, where the queue would take the trading window into account, so that if someone sends a trade that happens in the that would happen in the trading window, that would automatically be pending to happen at the start of the next session. I'm not sure if we already touched on that, but I was getting your opinion.
Well, so TradersPost does actually work that way by default. If you send an order when the market is closed, and some brokers don't allow queuing the order on their side. So instead of us sending the order to the broker when the market's closed and them rejecting it, we'll queue it on our side, and then we'll send it to the broker at the next market open. But as far as making the trading window behave that way, I guess it could definitely be an option where if we receive a trade outside of that trading window, if a checkbox is checked, it could send it. I guess it would send it at the beginning of their trading window, not when the market opens. So it would be possible. Yeah, it would be tricky to implement, I think, but possible, because we basically have to be monitoring. We need some system for triggering trades whenever the trading window starts.
That's right.
And that could get complicated with a lot of customers.
All right, so let me give an easier one over here. Someone was asking if it's possible to have commas be allowed within the quantity field.
That was definitely, Mike sent that one to me. And I did make the change. It's not in production yet, but I did queue up that change in our development environment. But I did have some, I was going to ask you, Mike, I mean, I feel like that might be bad in some cases. Like, what if you send 1, 0? Like, if I just strip out the comma,
Now
what
it's
if you
10.
meant that? What if you meant it to be 1.0? Like, people use commas as a decimal. Like,
That's
that's very common.
It's a format that's outside of the United States, but I agree. I think at the moment we clarify that it is a numeric field in our documentation, right? In this particular case, for whatever reason, the comma was being added as like a standard number format before the signal got sent over to us. And it's one of those things where the user didn't have the ability to format the number before they sent it to us. So it's a question of convenience versus all. Yeah, like we're not going to capture all use cases, and we'll still have to deal with the errors that may occur when we strip a comma from 1, 0. That's a good use case to think about. But in general, of course, we want to make sure people send over the data properly according to the format suggestions we have in our documentation. So for numeric fields like quantity fields, our suggestion is always to make sure to send it as a number and not as a string with any kind of formatting associated with it.
Yeah, that's kind of my take. I mean, APIs, especially financial APIs, like they need to be explicitly correct, and like you don't want them to be loose with like the types of data that get sent over. I would want to learn more about that specific customer. Like, where did that number come from? They sent 1,000 with 1 comma and the 3 zeros. Where was that coming from, and why couldn't they change it?
That's a good question. We can follow up on that.
Okay. Is it too loose to have it that the comma only gets removed if there's 4 characters or more?
I mean, you could get into that. You could do that, I guess. Yeah, I guess I could add
there's
that.
There's definitely going to be some bugaboo.
It's just that's the whole point. Like you start thinking about it and you're just like, this is too complicated. Just send a correct number. Like that's kind of my opinion, is like you're bending over backwards to like fix something that actually probably makes it worse. And this is the first time it's ever been requested. So like, it just feels odd to like change something fundamentally about the system because one person couldn't send a number without a comma in it.
Yeah. And I think that that's a fair assessment, but it's also a developer assessment, right? Like we tend to take a pretty engineering viewpoint on things. We do want to support the crowd of people who use TradersPost that I would consider the more no-code users, right? Who don't or can't rely on programming in order to format these messages before they're sent our way. So let's assume for a moment that this use case kind of supersedes the fringe case of a foreign formatting of 1, 0, and think about it from a common perspective. As long as it doesn't break more than it solves for, then I think we're in the right direction. But I hear you. Maybe you're right. If we start to having to add extra rules to it, like the number has to be at least 4 digits long before we remove the comma, then now we're getting into a too complex of a domain.
What else am I missing? And I don't know, like what if someone's sending signals right now and it's getting rejected because 1, 0 isn't valid. Mm-hmm. Then all of a sudden we make it valid. And now that order goes through with a quantity of 10. It just doesn't
seem. Or in crypto where the decimals could be 5 and then all of a sudden it's a way different number.
Yeah, and then I was thinking there might be a 1,234.0000005 because it's like crypto or whatever, and that obviously passes the.
Well, I'd have to count before the decimal.
Yeah, so it gets complicated real quick. There's no question. Unfortunately, though, because this isn't really an API, it's a webhook. We're kind of limited in our ability to throw back an error to the user unless they're seeing it in the rejection screen. So in general, I think the advantage of having a system that cleanly escapes characters and cleans up characters on their way in is an advantage for customers, but we just have to weigh these things carefully.
And we do a lot of stuff like that. Like I call it fudging the JSON. Like when we receive the JSON, like I do some checks on it. Like if it's missing the opening and closing curly brackets, like I'll fix that. There's a lot of common mistakes, and like we use a special JSON 5 parser. Whoever invented the I can't remember the name of it. I think someone at Apple invented it. It's the left curly bracket and the right curly bracket for double quote, or sorry, not curly bracket, double quotes. The left double quote and the right double quote is technically invalid JSON. But on Mac and on Windows, when you type a double quote, it will change it to that special left side and right side double quote. So anytime anyone pastes JSON from Mac or Windows into the TradingView alert, it's got those special double quotes instead of just the plain old OG double quote. And when we received that, Traders was like, this isn't JSON, because it's not. But the JSON 5 specification does allow those new characters. But it's an example of, it's like one of those things, like why it looks technically correct because it shows you like the left one is angled and the right one is angled that way. But like it literally, in my opinion, didn't improve anything except make all developers' lives worse. But anyways, we do fix stuff like that. So I'm open to adding more.
What if the user threatens to cancel their account if they put in the feature? Will that motivate you?
I'll give them the deuces. Peace.
Number of times I see that in the support tickets. I go, well, I'm going to have to cancel my account if you do that. Okay, then I'm going to have to. All right. All right. Next up, well, I thought that was going to be a simple one. Let's see if this one I think is going to be a complicated one. You let me know. Someone was asking if there's they would love to have the ability to identify options with the highest open interest and volume so they could avoid low liquidity options.
Yeah, it's definitely something Mike and I have talked about a lot. In general, we want to add all kinds of new filters to the option chain scanning. Right now we're limited to just, the position of the strike and how far away it is from at the money. There are, the main kind of issue that stopped us originally was just we didn't have the data. But I think as we get bigger, we'll be able to buy some of that data, and then we'll be able to incorporate those filters into our filtering mechanism. But definitely there's a long list of things that we could do. Other things people have requested is like they want to just, you could sort of do it by filtering off of how wide the spread is, either a percentage or a dollar amount. It's not like a direct it's not as precise as what you just described, but like if something has a really wide spread, then it's kind of an indicator that maybe it's low volume.
Yeah, I would say too, in anticipation of TradingView looking to expand their support for options data, both of those particular indicators should be fairly well covered as they roll out options data across U.S. equities. At the moment, at least from what we can tell with their support of the Indian, is it just the Nifty 50? It's That's just right. The index there, right? Yeah. So they have all of the forward contracts for the Nifty 50 out there, and the open interest data should be available as well as volume. So you would be able to build a Pine script around that in the future, presumably on U.S. equities once they roll that out. Of course, we have zero clue about when TradingView is going to start supporting U.S. options, but that might be something sooner available to you rather than waiting for TradersPost to integrate some of these features. That said, yeah, I'm right there with John. We've got a couple of vendors we've talked to about providing options data to us. And of course, we can do some of these calculations on our own, as long as all the data we have or we need is available from the broker that you've integrated with.
I'm so excited I've been trying out the professional accounts with to access the tick chart data on TradingView. I know it's not on all assets, but it's been fun to use. And I just keep thinking about having the tick chart plus the options, like the tick chart on the options charts. And it's going to be like, well, that's everything I've ever wanted. That's as granular of details I've ever wanted. I'll be able to calculate all kinds of different things. But the length of time, I know they just released it recently, right? We only found out recently, but it still feels to me very Song of Ice and Fire. Like I'm waiting for the last book in the Game of Thrones series. Just years and years and years. But I know it's only been a few weeks, so let's see what happens before the end of the year. All right. There were actually other other feature requests, but I'm not going to belabor the point right now. For
let's hear them. Let's do it. We're on.
I didn't even put it on the list. Well, there's one
Okay.
it wasn't a feature request. It was more of a criticism or ask. There were about the where you have to specify the asset class for the strategy. And the question was, well, since we know what the asset class, if that can be inferred from the symbol, why do we need to specify it, and why is it required? Why can
It's
it just
not
be
actually
open?
true. I mean, ticker symbols are not unique across asset classes. We could maybe, I mean, it's tough. Like you could get it right most of the time, but like ES is a stocks ticker as well. So like,
Right.
how do you know which one? I guess we could. No, we need it. We need the asset class to be defined on the strategy so that we know the universe of tickers to look in.
We've
But
also
when it
got
shows,
ticker filters that take place when you create your webhook. So if you only want it to support a certain list of tickers, we need to know what asset class you're referencing as well, right?
I mean, there's another way that we could do it is like we could remove the asset class from the strategy in the webhook, but you have to specify what the asset class is in the payload.
right.
And like that seems worse, like because you have to do it
That's
every
saving
single
me time.
time. You're actually making it worse. Another way that I see like TradingView does it is you have to prefix the ticker with the exchange. That would limit the universe. Like but even then, I mean, I don't know, but there might be scenarios where an exchange supports few. No, I don't think that would be the case. I think you always have to specify the asset class because you need it in order to know is this a stocks ticker or a futures ticker.
That's right.
If I'm wrong, someone correct me. I'd love to remove that restriction or that, but I don't think there's a way to do it.
All right. A little scenario here. Let's pretend we are in high school. If I send 2 stop limit orders, actually I shortened this down from what the person actually wrote. If I send 2 stop limit orders, one to open a long and one to open up a short, how do I cancel one of the orders if the first one is executed or one of them is executed?
You'd have to do it manually. There's no way, and most brokers don't support the ability, or not most, but some of them don't support sending a OCO after the fact. You can only send an OCO with an entry order. So in theory, if the brokers had that capability to send an OCO after the entry order is filled and the position is open, then TradersPost could support you sending a payload where it would have 2 orders in it, and we would send that to the broker in one request, and then the broker would cancel the other order if one of them fills.
Yeah, I saw this particular support ticket come through. It was a good question, and I've done something similar in the past. It was sort of a range breakout strategy. So I want to buy stop order above the range and a sell stop order below the range. I'm going to go short if it hits the bottom. I'm going to go long if it goes above the top. What I found more useful was to create the triggers to enter those positions if the price crosses from TradingView. And so that makes it to where the order isn't with the broker in advance, but it's a fast enough alert that I'm executing my trade appropriately at the time that the price crosses. So that was the recommendation in our email response to that particular customer, just to keep that logic over on the PineScript side.
Yeah. Technically, you could send both of those orders, and it just still wouldn't be guaranteed to work. Like if one of them fills in TradingView, then you could send the action equals cancel and it would cancel the other order. But
if you send action equals cancel along with that ticker, it would also cancel any other orders available for that ticker.
Right. But if you did it like after the other order filled, like wait a minute after it fills in TradingView, but it's still possible that like it could have filled in the broker and not filled in TradingView, or it could have filled in TradingView and not in the broker.
It's true.
So yeah.
And you could have set like 5 orders for future things, and then all those are done.
Right. Yep.
Is the issue that the order, like Traders Post, we wouldn't be able to find that order, like reference it, or is it some other issue? Like if someone
Yeah, I
had
mean,
an ID tied to the trade inside of the payload, could we
it could
reference
be
that ID?
possible. It could be possible for us to enhance the TradersPost system to like identify specific orders, but we don't store the orders on our side. We just fetch the list of open orders from the broker. And the only real way we have to filter it down is by ticker. There's no like identifier to say like, I want to cancel this specific order. And the origination of that feature was when people use take profits and stop losses that get sent with their entry order. They later may send an exit signal that comes from their strategy. And that exit signal, maybe it's like based off of a moving average crossover, or something more dynamic than just like, did the price hit this price? And when that exit order gets sent to TradersPost, we have to cancel all orders that are like locking the quantity for that position. Because if you don't, the broker may reject the order. Like if you have a position open for 10 shares of Apple, but you have a stop loss for 10 shares of Apple, I can't send another sell for those 10 shares because that quantity is locked. You have to cancel it first. But this is weird, and I don't fully understand why. Some brokers actually allow you to submit another sell order, and that other stop loss will just remain open. And if that stop price were to get triggered after you manually exited that position, you would then end up short. So TradersPost has like a hard, fast rule. We cancel those orders, and we don't send the exit order until those orders are fully canceled in the broker. And like we've confirmed that the status has changed to canceled.
Understood. Perfect. All right. Next up, is there any security risk or danger to my person's brokerage account when sending a signal from TradingView to TradersPost?
I mean, technically, that webhook URL is like a password, essentially. That the unique URL that you get that TradersPost generates for you would allow someone, if they got a hold of it, to send orders through to TradersPost. And if you have a subscription tied to that strategy connected to your broker, and the payload that they sent was for a ticker that you allow, it would make it through. And I thought a lot about this, but like, why? What would be? There's no way for someone to benefit from that other than just causing chaos and like ruining someone's day, which may be possible. But when you connect your brokerage account to TradersPost, they don't give us access to withdraw funds or add bank accounts. We only get the ability to read your open positions, cancel orders, create orders, fetch your account balances. That's it. The only other scenario, and I think this is far out there, and I think I've seen it done with crypto. Technically, if someone were to get a hold of, like, I can't remember who it was. I think it was who was it? 3Commas. Like 3Commas, I think, got hacked, and they stole all the API keys for like all their crypto accounts that were connected to their account. And then I think they basically like pumped up some shit coins with a lot of crypto accounts by just, submitting orders in mass across a lot of people's different accounts. And then they pumped up that shit coin, and then presumably they dumped their coins into that buy volume. But on the TradersPost side, we encrypt those API keys. We have all the standard security that you would have to protect that kind of data. It gets encrypted at rest. Our application fetches it and decrypts it in order to use it when we make calls to the brokerages. So there would have to be multiple security failures at multiple levels for someone to be able to get a hold of that data. But on top of that, I don't see what the motive would be. Like, besides someone just wanting to cause chaos, which I guess is a thing. Like, some people, they just want to like see someone else in pain. But there would be no way for them to extract money from your account or do anything with it.
The one scenario I can think of would be spoofing the books. So you'd want to create an excessive amount of demand on one side of the bid or ask and create that in order to profit from the additional demand that follows onto that, right? In general, scalpers are pretty sensitive to the amount of orders that show up on the DOM. And if they see a bunch of limit sell orders suddenly showing up on one side, they may crowd in and try to jump in on that opportunity.
Yeah.
So in theory, if you want to create liquidity in market, or if you literally need to create liquidity, then you would need a bunch of accounts to post those orders for the other side of the trade.
Right. And the customer has full control over the access. So like even if you got locked out at TradersPost, you can revoke the access that TradersPost has to your account from the brokerage side. Some brokers even go as far as like, if you change your password, like I think Schwab and TD Ameritrade, they behave that way. If you change your password, it just immediately revokes the access to everybody who you had connected your account to, which is a good thing from a security perspective, but it also causes a lot of problems because it's like I forget my password trying to log into TD Ameritrade, and I reset my password, and then it disconnects my account from TradersPost, and then they come to us saying, "Hey, why is my account disconnected?" And it's like it's an indirect cause, and it's not obvious that it was caused by you resetting your password.
But
I always
to clarify this point, though, that you mentioned early on in this discussion, though, John, the webhook URL is like a password, and we purposefully use extremely long UUID keys, if you will, in that URL. So it's not easily guessable. It's very unlikely that somebody's going to actually discover that URL because you're setting it in a private form on TradingView in the webhook URL form. It's not something that shows up like you shouldn't be pasting that webhook URL in a Discord forum or something like that, because then obviously that would give people the ability to post to that endpoint. So treat it like a password, and I think you're in safe hands.
Yep. And you do have the ability to, like, if you did accidentally paste that webhook URL in a Discord, if you just go into the strategy and click generate new URL, it'll invalidate the old one. And anybody who has that one, it will no longer work and you'll get a new URL.
Yep.
Excellent.
Adventure Trader had a question. He says, if I had more than one TradersPost account, could I copy trades via TradersPost, my trades on one account to the other accounts? Yes, you would basically create one strategy, and then you would give all of those other accounts access to that strategy. And whenever that strategy receives a trade, it'll execute the trade across all of the subscribers that are connected to that strategy.
I just want to comment on what you were saying before. I find it interesting when I see complaints, however few they are, about a trade that was missed because of a security issue, or oh well, we didn't let this go through because this wasn't done exactly right. Some of the cleanup procedures you were talking about for the JSON payload, and what I always want from a financial institution is that they err on the side of I did not get into the trade. And I almost feel like when I see a complaint from someone goes, well, I missed a trade that would have been so good, I think to myself, well, good then. I mean, that's exactly what you want. You don't want to be coming here for the opposite. You let 3 trades go through that shouldn't have happened.
Yeah, I mean, the system, like, things have to be explicit. Like, you don't want to let stuff through that's incorrect. Like, it's like you want it to go through when it would have been good, but when it would have been bad, you would have been upset that it went through. I think the lesson is that there's always going to be people complaining, no matter what you do.
Have you guys heard of the Chase money glitch trend?
I saw talks of it on social media, but I think I'm an old fart now, and like I saw it, and I was just like, "Oh, something's happening," and I didn't click
Wait,
further
you
into
didn't take advantage of it? I made like $100,000 doing it.
it.
Free money.
I saw some guy like a screenshot on Twitter that he actually lost money, but I didn't
Everyone
understand
lost
what it
money.
was.
Well, everybody's going to lose their ability to be a free man. I know that much. They're all going to
Right.
prison.
So what was it? I didn't see what happened. Like
They were
It's
just
check fraud.
depositing. Yeah, it's just doing basic check fraud. They were writing checks to themselves in their own accounts and then withdrawing the cash.
But they had
And-
never heard of that before. And so they thought, oh, deposit 100,000, you could withdraw 50,000 or whatever it was, and it's a glitch, it's a money glitch. But they would stay at the bank, right? So the next day or whatever when the check cleared, they look at their account and there's negative $80,000. I'm like, what's going on? They're like, where's my money? And they're like, well, no, this happened. He's like, no, that was a glitch on your end. That's not on my end. I need my money that was in my bank account. I'll tell you, that was a good TikTok week for me watching those videos.
Still
pretty
fraud.
funny.
Still fraud.
I love
the reason I bring it up is that I don't know how it is in the other banks in the United States, but in Canada, like you could never do that. Like there's no you couldn't actually deposit the money in and get it out right away. None of that is even remotely cleared to the degree that they were getting it. Like deposit, you have $2,000 in your bank account, you put $80,000 in, you take out 50,000. Like that doesn't. I've never.
That's
heard
the
that
way
happen.
it is. I mean, I use Chase. I just actually switched to Chase when I moved to Michigan, and it takes a while for the money. Like you don't get access to it right away. It's like in a pending state.
Yeah, it's usually they'll usually approve a certain amount of the check in advance. So usually it's like up to $1,000. And then the rest has to clear before they'll release the rest of the funds. So I haven't seen these videos specifically. It's a little unclear to me how people are withdrawing that much cash, because even first, ATMs rarely carry that much cash. And then two, there's a withdrawal limit on all Chase accounts. It's usually around $4,000 or $5,000 a day. So, you're capped. The only way that you would successfully do this is to do it over multiple days and to keep depositing checks and then withdrawing some small amount over and over and over again without hitting your daily limit. But no one's pulling $50,000 out of an ATM. I don't really understand how that happens.
So if I understand correctly, if there was ever a glitch, that was the glitch.
That was the glitch.
Maybe
is
the
that
limit's not there. Yeah,
they were allowed to withdraw it instantly. That's what the glitch was.
Yeah, and as soon as they found out about it, they put that not the whole amount, but large amounts, even on accounts that couldn't cover it, and that's what they then stopped immediately. So then people were like, the videos after that were, I couldn't get access to the glitch. Oh my god! I couldn't access.
So was it a hole in their software that existed forever and people just now found it, or did someone?
From what I understand, this is from people say they work in customer service and Chase, whatever. Obviously, we didn't get anything from Chase itself, but that's what it was saying. But the point of bringing that up is the idea that we wouldn't want something like that if it were true in TradersPost. You would want it to be err on the side of your thing didn't go through.
Yeah,
to protect your funds.
Well, I think it's kind of the same. Like when people complain about, when they get caught up in fraud prevention, but it's a legitimate purchase or something, it inconveniences you for that moment.
Right.
But then when it actually protects you from real fraud, the bank gets zero thanks. It's like you can't have it both ways. Like, it's just there are going to be those scenarios when you get caught up in that stuff and it's for your benefit. That's the way I look at it. It's a minor inconvenience to stop someone from just draining your bank account.
Like the other day, I went to the ATM, I put in my bank card, I deposited money. When I took it out, it said only 1 penny was deposited. So I was like, oh, easy problem to fix. Bank's open. I walk across to the bank and I go, hey, there's a problem over here. I need my money. And they're like, oh, sorry, sir. It's you're gonna have to wait 30 days or whatever for them to check the video camera and all that. I go, but my receipt says I deposited a penny. I didn't deposit a penny. We don't even have pennies in Canada. I did not do this. Please give me my money. It's in the machine. I'm sure if you open the machine, you'll see my money right there.
That is frustrating.
Like, sorry, sir, we can't do that. And they froze it for the next 30 days. I was like, all right.
That is frustrating. Yeah, I mean, I see it from both sides. Like it sucks when you're one of those unlucky people that gets caught up in those systems, but yeah, I don't know I think it would look much worse if those systems weren't there. There'd be a lot more pissed off people.
All right, just a couple of questions here before we switch to after hours. Someone was asking about the TradeStation offer for is the $50 TradeStation offer only for the first 500 and then 25,000, or can I get $50 for every 500? That has to do with the
Yeah, it's
the catch reward.
only on the like initial funding of the account.
Right.
I will add to that though, Robinhood has some pretty amazing benefits. If you're a gold member, it costs $50 or $5 a month. They'll do 1% match on every deposit, which
But
is
only for IRAs.
only for IRAs. But then they also give you 5.5% interest right now. Obviously, that won't be like that forever, but that is the most. It's higher than what's the other one called? I had a bunch of money in Wealthfront for a while, and it was like 5%, but then I got knocked down to like 4.5 recently. So I just got a bunch of cash right now that I'm sitting on that I can't invest. But I moved it all over to Robinhood, and I mean, it's a nice chunk of change every month.
Nice.
But yeah,
That's
1% match on IRAs is pretty nice too.
It's how Robinhood's having to maintain relevancy since the post GME debacle.
Yeah.
It's let's get into savings accounts and IRAs now instead of trying to convince you to rush to buy GME shares.
Yeah.
Makes sense to me.
I think they had like record deposits. Like I think I read that in their last earnings report, that they've just been crushing it on deposits, which makes sense.
Shall we get back to the Traders Post questions?
Second to last one over here. If I use TradersPost to manage my trades, will I lose real-time data on TradingView? I don't have a separate market data subscription with TradingView, so I get live data directly from my connected broker, TradeStation.
We need to clarify where those trades are coming from. If you're not using live data to generate the signal, then you're going to run into a problem.
Yeah, I think you would need live market data from TradingView. I don't know, like when you connect your TradeStation broker, does the chart and the strategies use your data from TradeStation, or is it using TradingView's data?
That's what the ticket was saying, that they were using the TradeStation real-time
I don't
data.
think that's. I'd have to verify that, but I don't think the strategies like that and indicators that are running on their servers when you set up alerts, I don't think that's using your connected broker's data, because the market data from your connected broker in TradingView is like only connected to TradingView like while you're logged in on TradingView at the time. That market data like isn't persistently available, correct me if I'm wrong, on the TradingView server side.
Right.
I don't know. I think that's part of the problem. I don't know if TradingView uses a similar strategy that we do, where they collect market data on your behalf for the indicators and strategies in the cloud.
I don't think they do, because like when you close TradingView, like you can log out of your brokerage connection, and like if you close TradingView, the next time you come back, you have to re-log in to your brokerage account on TradingView, and that session like isn't persisted or maintained on the back end of TradingView servers.
I think you make a good point. I'm fairly certain it is mostly client side that it makes that connection to your broker. So it likely doesn't transcend to the cloud environment. So that means that TradingView gets their market data from the subscription in your account. And so if you're not paying for market data, then you're getting 15-minute delayed data from TradingView, which is going to put your strategy out of sync with the trade activity that takes place once it gets sent to TradersPost.
Yep. So if you connect your brokerage and like you're using the TradingView trading panel with your brokerage account, are the charts powered by the broker's market data? It is.
Yeah.
Well, that's kind of confusing, right? Because like you could basically be manually trading with market data from your brokerage, but then your alerts are using different market data. That doesn't line up to me.
That's what made me confused as to whether or not the data transcends over to the cloud. But
I don't think that it's using the brokerage's market data at all. I would bet that it's always using your subscription market data. And the only thing that the brokerage connection is being used for is transmitting orders, canceled orders, create orders, and reading your positions to show it on the chart.
I can tell you that there's a notable difference in the way you can tell that it's your broker data versus TradingView's data is you'll notice a difference in the DOM. when you make the connection, the DOM will change. And that's because I think TradingView gets aggregated data, but I've never run into this issue because I've always paid for market data on TradingView and with the broker if necessary. So that those two are usually in sync. And at least with futures data, we're all getting data from pretty much the same place. With equities data, it could be slightly different though.
I was just Googling. I mean, it's an AI response, but
So it must be true.
yeah, we'll have to verify this. But when you connect your broker to TradingView, TradingView uses your brokerage data through a client server architecture. Yeah, I don't know. That's a good question, though. I want to get clarification on that.
Yeah, we can reach out to TradingView on this one. Their team should be able to answer that for us. That's a good one.
Perfect. But for now, we're after the close, and we're going to move over to after hours. But before we do, I want to say thank you to John. We have to send him back into the bowels of the starship. NC1701. Get back to the traders. Add those features in, or I'm going to close my account.
Where's he going? He's disappearing.
All right, guys. We'll see you next time.
John.
Yep. Have a good weekend.
See you, John.
Bye.
All right. Welcome to After Hours, where we talk about the markets in view of automated trading and trading in general. I'm Tom Hartman. This is Mike Christensen, and what a week it has been. I almost put in clips from last After Hours into this one just to show how right we were, that the sky didn't fall. We didn't end up in new lows for the S&P, and for our first story here for NVIDIA, wow, it has soared. But before we start, let's just recap some of the major headlines for this week. These are my favorite ones here. We have the NVIDIA stock that's popped 8% as CEO Huang touts demand for chips. NVIDIA soars today thanks to AI news. Is it time to buy the stock again? Next, we'll be talking about China. 10-year government bond yield has fallen to record lows of 2.0775%. We're not going to hit China specifically, but we're talking about the idea of recession and should we be on recession watch. Global ETF flows on course to soar past previous records, and the job market is flashing a classic pattern that signals a recession. That a recession is coming, Citi says. And then finally, we'll touch on gold. Gold news here as Beyond hits a new peak on the weak dollar and Fed speculation. We have some nice tweets here from Cross Border Capital talking about the ISM, as well as Nassim Nicholas Taleb hitting up on gold. And whenever he talks about a specific asset, I like to listen. So I don't know if you've been enjoying the bounce off the lows for, all kinds of assets, Amazon, NVIDIA, Bitcoin.
Yep.
But this is pretty much in line with the sort of things we've been talking about over the last couple of weeks.
Yeah, 100%. And I'm still very bullish on NVIDIA. I bought on the way down on that last retrace for NVIDIA. So I managed to average in quite well in this last little move. And obviously the whole thing started to push up from here. So I'm looking to see NVIDIA push past its all-time high. And I'd like to see it go a little bit further than that. I've got, what did I set my price target at? I'm thinking the last estimate, I've got it somewhere at the 157 to 161 range. So I'm hoping for a nice big push from here. I think the main thing that's contributing to it is really a lot of what Huang put out on his latest bullish view of just the future of AI. The estimates that they're making on an ROI perspective for server providers out there that can expect to launch the new Blackwell chips. The demand for Blackwell chips are incredibly high. Their supply chain issues are fairly well ameliorated, especially with the relationship with TSM or Taiwan Semiconductor. And in general, the biggest thing for me is the moat that NVIDIA has. There's just no competitor out there that has a chip that is application specific in this way that solves our specific generative AI problems. And it's serving the entire landscape of AI at the moment, even at the cloud infrastructure level. So I'm still very bullish on NVIDIA from here.
There have been claims here that I just find it because I'm not in the hardware space at all. I don't have that type of understanding. There's some claims here that I mean we're not even halfway up to the price that Nvidia can get to because the bearish case that I've been hearing, and let me know if you hear anything different, is that this is benefiting from the AI hype, and it's one of the only stocks that's clearly invested in the clearly is a beneficiary of the AI bubble or the AI momentum, and that as soon as something else comes into to play, well, then we'll move to there. We'll move to software. We'll move to other players, and then the stock will fall. But that to me does not sound like a 2024 story at
No.
all. And there's plenty of runway between now and the end of the year. And
Mhm.
if you'll remember last year, the Santa Claus rally that just completely ripped some of these stocks to the upside because of this forced buying that happens at the end of the year, makes me think that there's no reason not to expect all-time highs on Nvidia before the end of the year and then some. What's your expectation before the end of December?
Yeah, I think it's the same thing. Maybe the thing that's kind of overlooked in terms of demand perspective for graphics cards to support AI initiatives is really at the private sector. There's a lot we don't see in terms of where this demand is coming from. We hear about the investments that are being made from a CapEx perspective across the public markets because we can see that. We hear that in investor calls. We hear that in earnings reports. But there's a whole massive private industry in America that is obviously increasing their demand for these types of graphics cards in cloud infrastructure. Right? They're heading to DigitalOcean, they're heading to Azure, they're heading to AWS, and requesting those types of servers to be spun up so that they can run models of their own. And again, NVIDIA is the obvious benefactor for that. As more and more of these or not digital, but cloud providers are expanding their infrastructure to include NVIDIA cards as part of their service, that demand is only going to grow. So I'm definitely a pretty bullish on it. I think the bear case for it is really not knowing entirely where the demand is going to come from in terms of magnitude, like how big that demand is. It could be smaller than we anticipate. And it is possible for NVIDIA to overinvest in their supply and maybe end up with some extra cards on the sideline. Doubtful to me, though. I just don't see a world in which NVIDIA has any trouble selling these cards and even using them as collateral in some way.
What makes me feel nervous about it, and maybe a comment out of left field here, but whenever I hear these, I can accept a stock really taking off. I can accept that. But when there's this refocus on this sort of like legendary CEO of this company or legendary leader, I get very much Elizabeth Holmes sort of vibes.
Mm.
And then when I see that leader come out on stage with like uh, his story of how he started, and then how we're a different company and how we do things differently here, how I was always shunned for the way I was doing things in the past, and he's saying all this inside of a leather jacket that should really be on somebody 20 years younger. I think to myself, okay, I'm being sold something here. But then Elon does the same thing. So then I go, okay, I mean, it's just the style. So I'm not sure what to think there. But the thing that really makes me nervous is the tone of it. It feels so much like when a crypto coin launches, even if it's a legitimate crypto coin with new technology and innovation and staking and transfer or whatever it is. They go, okay, I hear the words for the technology, and I go, okay, that sounds good. Those sounds like tech words. I like that. And then I see the number go up, and then I have no way to associate the price that I'm seeing with the tech words that I've heard. Do you get any misgivings at all that Nvidia specifically, aside from whether you think AI is worthwhile, that the price rise itself is 40%, 50% hype, or do you think no, we're really in fundamental territory and we're just starting?
Yeah, I think that's in general how I tend to look at markets. I'm trying to look past the headlines in the news and some of the glitz and the hype around it and just look at the actual demand, right? Like what companies are demanding this technology, how many people are actually adopting it as part of their process. And in the past, when I've considered other industries as whether or not they're in a hype cycle or not, a lot of it has come from there being more focus on the promise of the future of something rather than what's practical today. And I think NVIDIA is one of those practical applications, right? They have a real solution to a real problem that has real demand behind it. And they happen to have the best product out there for that particular problem. These graphics cards are repeatedly used in these scenarios where if you need this type of processing power and the demand is great enough for it, suddenly the market for NVIDIA cards goes haywire, right? Like
Right.
when the cost of mining cryptocurrencies could be done through like the Ethereum blockchain and you needed NVIDIA graphics cards for it, you went to NVIDIA because it was it had a faster hash rate than any other graphics card out there. So I think we find that solution, that same type of scenario playing out here where AI is best served through this type of hardware technology, and NVIDIA happens to have the mode on it. So I think there's a comment here. He earned his leather jacket. I'm going to say that Huang actually earned his leather jacket.
That's right. Excellent. All right. So, would you give me a price target for what you think happens for NVIDIA before the end of the year, or
Yeah,
whatever
I mean,
time frame you want?
from a technical perspective, I've effectively averaged into this recent retrace, which actually it went just a little bit past the 0618 retrace. So I would consider this the beginnings of a fib extension from here. So just from a technical perspective, if we pass that recent resistance zone around 133 and the all-time high around 140, I would expect us to start seeing some exhaustion around the 157 to 161 range. So we've got a ways to go. From here, there's another 33% potential upside, and roughly almost 50% return on my averaged investment on NVIDIA. So I'll be excited from my perspective because I managed to catch that bottom.
Nice. Tell me what feels better, the gain or being right on a trade?
Both.
I speak as someone who's lost too much. I just being right, except for all the times I was wrong before. It feels 10 times better than any money that I gained.
No, obviously I'm not in the game to be right. I'm in the game to make money. If I'm not making money doing it, then I don't care about being right. Because
The thing is, the money
I could show you
Go ahead.
100 trades I would have been right on if I would have taken them.
Well, the money that we make, our wives spend, but being right, we own that. No one can take that away from us.
That is true, and that's why I get to manage the family funds. Peter reminds me to remind everybody this is not financial advice. I'm not being paid by NVIDIA to make these statements, nor would I accept payment. Yes, I would accept payment.
All right, so I want to move off here to Recession Watch 2024 or 2025. That'll be the Recession Watch 2025. I'll get a nice little banner and dramatic music to play because this is a story that's going to be evolving over the next year or so. If I remember correctly, like you're not in we should really be bracing for recession within the next 6 months. Like that's not what you're looking at, right? Because I'm not seeing that in the data either specifically.
Yeah, I'm holding a neutral stance on this. I think the data could be told both ways. And while we are seeing a cooling of economic data from a jobs perspective and a GDP growth perspective, it's not so bad that we need to start raising alarm bells here. I think we're at a point in which people are literally having to invent indicators like the SOM rule in order to say, oh, a recession is inbound here because we're so convinced that we must be nearing a recession. But again, even from a technical perspective, we want to see a rise in unemployment and 2 down GDP quarters before it's even considered a technical recession. And quarter after quarter, we've posted growth in the economy from a GDP perspective. And at 4.2% unemployment in the United States, that's effectively full employment. So these primary indicators for economic strength are still pointing to a strong economy, even though the long-term data, as we look at, the last, roughly 1 year to 1.5 years of data, are starting to pull back a little bit. It's not so bad that it's a concern. To recap.
I find it so interesting because I, the recession is a contraction within the productivity of the nation, and there's a case to be made that what is it like GDP is being made up of like 40% government spending, something like that, some high number of government spending that's happening, that's propping up GDP. And then some people go, well, then that's a sign that the real productivity of the nation is much lower, and we're in a recessionary territory. But if you actually go by that number, we've been in recession 10 years. And if that's the case, well, then we got to have different words here to describe what we're talking about. For us who are in markets, what we have to think about is the liquidity, the capital, and the ebbs and flows, right? If we're talking about whether some group of individuals might lose their jobs in a particular industry, okay, if that's that's where you're at, that's what you're going to be paying attention to. And so if I was like a hiring manager at some factory, okay, I'd have completely different considerations, which I understand here. So for example, just to show the not this one, let's go with, okay, so we have, so in the background here you're seeing the chart. This is the ISM. And so the ISM, which basically a diffusion index that tracks the expectations of the production industry of a nation, especially the United States. It's what they're expecting. These are all their expectations, and the expectation is that we're headed towards a contraction phase, a recessionary phase. But we are at the lows of this cycle here, right? So even if we go down a little bit further, it's when we're up at the top of these peaks that it's the real danger, right? That sort of cliff down the other side. But we've been sort of prepared for a recession. Like you've been hearing this along with me for the last a year and a half, maybe even longer if you're hearing the whispers. Recession's around the corner. Recession's around the corner. And so you really need something to come as a surprise for it to really hit markets really hard, something big. And we're getting news here that China, the bond market is being the yields are dropping. We're seeing yields drop dramatically in the United States as well. But it's not off a cliff. It's this trend that we can actually see. So we're getting it. There's not going to be over hiring happening now that they're going to have to roll back over the next year. There's not this euphoria that's happening with at the top of markets where people are overspending and over traveling and all that sort of thing, and new loans are being created. We're not getting that. And so what I'm actually seeing is that these signs of some weakening within some of these growth signals are the reasons why the Fed has decided, okay, we're going to cut. Right? They're not waiting for some big crash to happen. They're like, okay, we're going to start easing now in order to help support markets. And that's bing, 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 bing. That's liquidity coming in, which is what we want as market participants. And so people are expecting to see the recession happen within the charts.
Mm-hmm.
And until some big catalyst comes, that some black swan thing that we're not seeing, I don't know how you can actually prepare for that, because nothing is saying that should happen. We might get a little bit of slowdown, right, headed into October. Hell, if we drop 10% in equities, fine. But we just saw Nvidia drop, what was it, significantly over like a week and a half, and then rebound. Amazon did the same thing. Bitcoin is up from its lows. I think liquidity is showing that things are going to be fine, if not a rip roaring over the next year. Now, sorry, go ahead.
I was just going to say I've been watching a lot of this unfold for some time now. I have another chart that I use for this just to kind of get a sense of where we'll see it coming, and I'll share this one real quick. So this is a breakdown of all the historical recessions and effectively the unemployment rate in relation to the S&P 500, right? And one of the things that I can say pretty definitively is that we tend to get a signal of drawdown in the market before the recession is even called. So if we're going to see any kind of signal about an inbound recession, it'll come in the form of a fairly large drawdown in the S&P 500, roughly 15 to 20% overall, as an early warning of a rise in unemployment and overall the call of a recession. Almost every instance in which this green bar represents every historical recession we've had in the past, you can usually see a decline in the market of roughly 15 to 20% or more before we've even called the recession. So the way I've personally always looked at it is what are the markets telling us? As we're looking at today's data, we had this quick pullback in the S&P 500, which was that almost a 20% pullback. However, it wasn't enough to warrant any type of slowdown in overall growth. So I would argue that this run up since then has really come from the AI phase. And yes, we are starting to see a small increase in unemployment overall, but I think the markets will tell us a bit before I'm ready to call a recession personally. It'll always be the leading indicator.
Right. Are you using the GDP-based recession indicator index from the Fed, or are you calculating those green bars in a different way?
The green bars come from an indicator that I found on TradingView called U.S. Recessions. I believe this was created by Chris M665, and I believe it is it's pulling the data from Fred, which is the US RECD ticker.
Perfect. Oh, interesting. I haven't seen this one before.
Yeah, so super helpful to kind of at least understand how do these metrics stack up. The one takeaway for me was the markets are the leading indicator.
Perfect. Yeah, so unemployment is like the nail in the coffin. It's at 4.2. It is ebbing up, totally understandable. But to me, it's all about uncertainty, and no one is surprised that unemployment is ticking up. The Powell is talking about it. We're seeing it within the numbers. We're not surprised that this is occurring. So until something shocks me, and plus, every other shock we've seen has been met with a rebound, drastic rebound in the markets to all-time highs, faster than ever before.
We've talked about it before in the past. If we have another COVID situation, how fast is that V-shaped recovery? Now, I'm not under the impression that we won't experience some kind of a drawdown in markets that lead to potentially a 10-year lost decade. Eventually, we'll have to face that. But I want to see some economic indicators that really kind of support that thesis. It will have to be long periods of GDP decline. It will have to be low corporate earnings or even declining corporate earnings over the broad swath of components in the S&P. Unemployment rates that are unusual for the period that we're in. But right now, things, balance sheets on equities look strong and healthy. It seems like forward guidance looks good. Unemployment is still full employment. I'm just not seeing it yet. Somebody convince me.
I don't even see a 10-year low coming anytime soon until the dollar is no longer the reserve currency, because we haven't had a long recession, right? They talk about the last one that happened is like the GFC, 2009, and they talk about it like that lasted a number of years before the markets are back up. But if you actually go back to the news articles of that time, they were talking about how it would be 2014, 2015 before the markets ever got back up to the levels it was at. And it wasn't. If you missed that 2009 low, you were laughed at the whole way back up. It did not take 10 years like it did in the dot-com crisis.
Right.
And that's because we figured out the QE. United States has the reserve currency, and it turned out the whole world needs dollars, and you can export dollars. You guys are not exporting TVs and cars and all that. You guys are exporting dollars, and that's what you're in. And it was a lack of dollars that was a problem, and you guys solved that problem, or to a great degree for a number of years. So until the reserve status is gone, I am not looking for a 10-year recession.
So I'm hearing that BRICS is ultimately the biggest threat to the U.S. stock market. Then, if there is ever an adoption of a even aggregated world currency reserve like BRICS, then we need to be concerned.
That's why you have to take a look at the. In fact, that's what Taleb was talking about. Actually, thank you for reminding me of that. Um, So here, Taleb's tweet here is people are not seeing the real de-dollarization in progress. It's not about it's not about trade settlements. Transactions are labeled in USD as an anchor currency, but central banks, particularly BRICS, have been storing. That is putting their reserves in gold. Gold is up 30% year over year. So this is the canary in the coal mine. Gold up. Gold is just soaring. What is it, up 60% over the last like year and a half? Like massive amount. That is the thing to be paying attention to, because gold is that is how we can tell if people are sus on the economic system, like the monetary system. That's how we can tell. That's how people express themselves. And when I say people, I mean institutions, including central banks and sovereign entities, like big money, not the your prepper neighbor. I'm talking about real money here going into gold. That's how you can tell that something serious is happening. But on the flip side, to touch on what we are just talking about before, this is the ISM with the from Cross Border Capital projecting liquidity conditions in the United States. It's indicating that we're actually ticking up, or it's projected that we might actually be ticking up in liquidity, which will then change the ISM diffusion index, because, like I said, that is based on opinions of the people surveyed, and those opinions can change based on the performance of the assets that they're paying attention to. So, like I said, I'm expecting a boom between now and leading into December, just because of the effects of whenever the stock market or assets are up headed into the end of the year, there are people who are then forced to, at the start of the next year, there are people who are forced to reallocate based on the positions of the performances that they had for the previous year. So they get a blank canvas. They have more collateral now, or their collateral is worth more now, and now they're able to leverage that more in order to buy into the markets, which is why you get this. Because that happens in January, you get people in November, December who anticipate that buying in January, and they buy into the markets. They cause the markets to go up even more, and then obviously those people who are forced buyers in January have to buy that much more because the collateral went up because of the Santa Claus Rally. And then you look and that's why crashes happen in February, March, because that's when that effect finishes off, and we go off the cliff.
Well, I want to highlight that there's a lot of liquidity that are looking for a new home as interest rates come down. Maybe one consideration to make here is the amount of people that have loaded up on money market accounts and savings accounts that are offering 5.5, 5.75 on high yield savings, that those rates are going to start coming down over the next quarter or two as the Fed potentially does 3 cuts by the end of the year. 3 cuts that could equal about a 75 basis point reduction overall, unless by some crazy reason they decide to cut the first one by 50 basis points, which I think is unlikely. And I think the CME FedWatch tool agrees with me on that one. That reduction in rates, though, is going to lower the yield you're experiencing from your savings accounts. People are going to start searching for higher returns within the market. And if there's this belief that we are heading into a pretty strong bull continuation, I think those funds are basically the capital we're expecting from the sidelines to help support some of this rally. And I think it's unusually high. The amount of accounts out there that are going to be looking for a new home from high yield accounts is fairly high. So that's worth considering.
That.
Yeah,
That absolutely correct. They're going to have to chase performance. That makes a lot of sense. I do have to mention there was a tweet. I wish I bookmarked it, where apparently there was some large bet placed that recently that the Fed would cut by 50 basis points come this month. If that's true, and if that does happen, I usually look for stuff like that, for like if there's going to be a crisis somewhere and it's brewing, and people in the know, you look for bets like that, and then you go, okay, so that's there could be some major thing that happens that causes the Fed to have to cut. But again, I hear all that, and I hear bullish. If the stock market goes up, it's bullish. If it goes down, it's bullish. I don't know how it's any other way.
Okay, fair enough. You know, what's interesting is the prediction from the CME FedWatch tool has changed, actually, again. This was I didn't realize that this number had actually come down quite a bit. It was at almost 75% anticipation that it would be a 25 basis point cut. Now it's 55%. To a 45% prediction of it going down by 50 basis points. So it feels like the futures market is fairly split or fairly divided on whether or not we're going to get 25 or 50 basis points.
It's because of that bet, because of that large bet. That was what the tweet was about, that the tool changed, the probabilities changed because of this one large player. But it was only one large player. But I always look for one large players. One large players, that's an indication that somebody knows something, because they I hate that phrase, but it's true. If you're going to be betting billions of dollars on a bet, or multi-million dollars on a bet, you're not doing that just for just for shits and giggles. All right, so I want to touch on the last thing we did. We did talk about it in the last segment about gold, and what I'm loving about gold. I mean, gold to me is I never directly invest in gold anymore. To me, gold is an indicator, and what I've been loving is that we've been talking about the dollar, waiting for the dollar to confirm its bearish trend in order to invest in inflation sensitive assets, or assets that increase with liquidity. And seeing the dollar has fallen. Forgive me, let me just get it here. Okay, let me pull up my chart. Okay, so the dollar is back down to essentially the 100 level, right? So if we talked about, I think it was last week, that what I was essentially looking for is this bear flag, right? I wanted the price to come down over here, bounce around in here, and then break down, because we're not going to break this 100 level with a simple move down. It's been support for years now, and so I don't even care how long we stay sideways over here, because the longer we stay sideways, the more I'm convinced that we then break suddenly. And gold and Bitcoin has responded accordingly. So we've had gold that's gone up and to the right, and now we're having Bitcoin right on cue here, hitting on the support. So it's right on this trend, and now Bitcoin's headed back up to test. Now we do have to break this level over here at 60,000. We'd have to break again this one over here at 69, and then again at 75, like we've talked about, to confirm. But what I like is being able to tell that, yeah, it is because the dollar turned and we hit right at this level. And when we had this, when that stuff coincides, where the dollar's fallen, but Bitcoin has risen right on a pivot that you would expect it to pivot on, that to me is usually a sign that now we're at the start of a trend, or at least 1 month to 3 month short-term trend that'll continue, and that's a bet you can take. And so that's what I've been doing since the bottom here, betting on a rise on Bitcoin from the lows here.
Copy that. Yeah,
how much
I'm seeing the same thing.
Yeah. So are you finding any meat to this move up, or is this to you? Oh, this could just as easily be another lower high, and we roll over down to the downside.
Yeah, I think at least with this this little consolidation range here, that I would argue we're kind of range bound. I mean, it's a fairly large range, but we keep touching these rejections off of an attempt at retesting a recent high, and it's those consistent rejections that have me concerned. So I would want to see it push past at least the 65.3 mark on Bitcoin's price, which is the most recent rejection price, to continue on from there. So this point here is what I'm looking at. I want to see us get past here. And I think that is pretty bullish, because that is the most recent high that would post a new high. That could be pretty interesting. Obviously, I tend to look at some of the shorter term moving averages. We've just closed above the 8 EMA. That's pretty promising. We've obviously found some support from this particular range of price, and that's also promising. But I want to see some higher highs.
Understood. What I find fascinating is that you've sort of like influenced my current trading style, because just opening my eyes up to VWAP, and to me, I love being able to count on. I have levels to where I think price will go, but then I had difficulty figuring out up until where it would reverse. And now being able to be like, okay, I could place a bet that it'll reverse probably all the way to VWAP, makes me look for that extension away from it and then a reversion back to VWAP. I'm very excited to read the book that you recommended to me.
Oh, cool.
Accurate
I'm glad you
VWAP
got a
from,
copy. Yeah.
yeah, I looked at about it online, and people are like raving about how. I mean, for God's sakes, John Bollinger has a blurb at the back saying that, hey, new innovations are rare in technical analysis, but he thinks that Brian Shannon here hit on one. When I saw that, I was like, hey, I got to be buying that book.
Yeah.
I will make a bunch of indicators for TradersPost. with some of the
I'd
ideas
love
that
to
he
work with you on those, especially in most of the book really kind of covers his technique for deciding on the position to measure from for anchored VWAP, because it's obviously different than session VWAP or some fixed time range. When you use anchored VWAP, you've got to make a choice about where you anchor from, and you can anchor from reversals, you can anchor from demand zones or from volume spikes. But I think you'll be impressed with the many different ways he has different lenses for where he makes his decision to position VWAP, but then also how he layers anchored VWAP on top of itself. So to find a trend, he's using multiple instances of increasing longer and then progressively shorter lengths of anchored VWAP in order to estimate a trend.
So that's what got me really excited, because the system that I use, my moving averages, I didn't realize were essentially that layered VWAP with multiple different anchors all working together. And I was always very surprised. How is this working so accurately? Like the formula that I used, I haven't read the book yet because I just got it like 20 minutes before we went on air. But I was watching his talks or his interviews, and my system does not require deciding where to anchor a VWAP. It covers every possible sort of like range. I didn't realize that was the case, because the formula that I'm using generates all the different levels from down to milliseconds up to hundreds of years, and I just choose a subsection for the charts. And I had programmed it before I even tried it on a chart. I didn't even think it could work on a chart. I just dreamt about it when in a dream, and I coded it, and then it just so happened to generate these waves. And to see now an explanation for why that works makes you really, really excited, because it's hard to bet real money on something when you're like, well, I just dreamt about how to do this. Now I can actually read something that'll explain it to me. So
Yeah.
thank you very much for that.
Yeah, very and a big shout out to Brian Shannon on the book as well. He's a CMT in the space, which for those that are not familiar is a chartered market technician, which in my opinion is the gold standard for accreditation or really designation for being a technical analyst. It's a program that I'm currently engaged in. I'm working on level 2 next, and hoping to pass it in the coming months here.
Perfect. So just before we wrap up, I just want to make sure I touched on, forgive me, I just want to touch on the gold. Okay, no, that's fine. All right, we'll just leave it at that. All right, it's been fun. Anything else you want to touch on? We're not going to make any Bitcoin predictions for this this week, but there is something. Oh, there is one thing I wanted to ask you. You were saying before that you're sort of neutral right now in the markets. What do you mean by that?
Let me pull up the Fear and Greed Index. If you're not familiar, this is on CNN's website. This is actually created by a friend of mine, Jason Meshnick, also a CMT. He wrote this 20 years ago, a long time ago. This is basically a measurement of multiple aspects of the market, and even this particular indicator is firing off a neutral signal at the moment. So what we're really measuring is market momentum. What is the S&P 500 showing us against 125-day moving average? And right now we're kind of at a greed signal there. Stock price strength in terms of 52-week highs is also showing about extreme greed. The stock price breadth, which is effectively a volume indicator, is also showing us greed. Puts versus calls showing mostly fear in the market, as most people are loading up on puts at the moment. and the VIX and volatility is starting to retreat to a below a 50-day moving average after that last spike that we experienced. Safe haven demand, junk bond demand are the last two, and effectively those are in fear and extreme fear. We've mentioned some strength in the bond market. The yields are retracing in some areas, but in general, I think yields are positive. So this indicator doesn't really cover like everything from an economic perspective, but enough to get a sense of how do markets feel about the forward returns of the stock market. And right now, we're just really kind of in that neutral territory. Since the stock market is really kind of, to me, a leading indicator of whether or not we're in recession territory, this neutral indicator tells me that I'm not sure. I'm not seeing it, but I'm also not. I'm not in a position where I think that it's impossible to occur. We need to see some. We need to see some declines in corporate earnings. I think some of this hype around the AI cycle needs to abate or at least level out. But right now, I mean, we'll know as we close out Q3 here. And we start to look at earnings, the next NVIDIA earnings report is going to tell us a lot about where that demand is coming from and how big that demand is. And I think that this is propping up a big part of the tech industry, since many of the Mag 7 are investing heavily in AI. Just look at iPhone's, Apple 16 release. It's AI everything now. Everything is, we're building an AI phone now. So I think the phase of changes that we're about to experience from an investment perspective are very let me rephrase this. The amount of CapEx that's going into AI right now is the big question mark, because investors aren't entirely sure how quick and how big the returns will be from those investments. So the thing we need to keep a close eye on is what the earnings reports look like over the next 2 or 3 quarters to see how AI has actually played a role.
So what I'm hearing is neutral code for volatility, for uncertainty that can go either way. Is the range of outcomes wide for you?
If I look at it from a technical perspective, I think we need to head back down into that lower VIX territory for a while and stay in that accumulation zone before I'm ready to say, oh yeah, we're going to see a breakout again here, a spike in volatility.
I see. Well, I want to see a dip in markets from September, October. I want the classic dip. Give me 10%. And then I know off to the races. To me, that's the gun in the air, and everyone has every reason in the world in order to pump this market as high as possible. The final thing I'll show is to me the greatest level of uncertainty, and I check this every day and multiple times a day, is the the election. And when I see split between these two, I go, of course, if I'm an American, I don't know at all what I should be betting on, and everything is up in the air. I don't know if it's going to be tariffs. I don't know if it's going to be open border. I don't even know what's going to happen. And so then I go, great opportunity for a catalyst to occur in order to buy. I sound like not that I hear myself. I sound like the people that the Occupy Wall Street people were complaining about, and I'm sort of starting to hear it now. They're like, okay, Tom is like, if there's volatility in there, that's where I can make money. So please, let's get it going. Let's start something new. Let's get some conflict happening. But whatever.
We'll get there.
There's conflict anyway. I might as well make money off of it. All right. So we'll leave it there for that. We're going to be back next week for more office hours. And since we're out of summer, out of the doldrums, I'm sure it's going to be one poppin' show. Have a great weekend, Mike.
You too, Tom. Cheers, everybody.